Okay, great. Okay, so welcome everybody. The chosen topic, as you can see, is investment strategies of the big players. And it's clearly an important topic for anyone with more than a passing interest in terms of what's happening in the real estate markets at the moment. Size does truly matter, and not least because it's the biggest players that today command the vast majority of the capital that is seeking deployment in the sector. In a bid to be in greater control of their investment portfolios following the global financial crisis in 2008, institutional investors have increasingly sought to partner with selected and smaller numbers of investment managers, and the net result of which is a marketplace dominated by far fewer, but consequently bigger brands. I'm the editor of PERE, and we're a capital markets-focused publication. According to our research, within the top 50 capital raisers, the top 10 of these firms now account for more than half of a 271 billion corpus of capital raised over the past 5 years. And that's a proportion that has grown, and we think, given current sentiments, will continue to grow. And now consider that point alongside the fact that across real estate vehicle types, there's today a whopping 440 billion plus of available capital for real estate globally. This is a Cushman & Wakefield number that I took from their Great Wall of Money report. And that total is the most the firm has ever recorded since it started running the report almost a decade ago. Then, consider the fact that most real estate markets, including many of those here in Europe, are at or approaching cyclical peaks. Indicative of this fact, transaction volumes are falling off a little. Real Capital Analytics, and I know you heard from them in the prior session, they reported at 107 billion euros. The first half of this year saw a 35% decline in deals in Europe from the same period in 2015. Brexit's obviously played its part, but unpalatable pricing that today reflects pre-GFC cap rates was already taking its toll well before the UK's referendum on the EU. Now, while managers are finding it increasingly difficult to deploy capital, the money keeps coming in. Low interest rates have seen lots of fixed income capital seek surrogates in real assets, and of course real estate is at the heart of real assets. And the spread between bond and prime property yields, which is obviously a key consideration for core property buyers, is causing some investors to take stock, reconsider their strategies. But in the absence, of course, of adequately yielding alternative options, it's hard to see institutional demand in this asset class dissipating. So to summarize, you've got record amounts of equity in the market, fewer and bigger managers accounting for more and more of it, and yields that are so low that less of it's actually being deployed. You might say that for the biggest players, as a result, these are pretty testing times. But let's hear what they have to say. And sitting beside me, we've got an aggregate of, I believe, if I've done my maths right, we've got an aggregate of about $260 billion represented on this stage, according to their websites, that is. And that's only 3 of them. Macquarie Capital, which is principally an advisory business to the biggest pools of money in the world, has committed around 60 billion of equity in the asset class since inception in 2003. So I think you'll agree they've got a fairly comprehensive view on what the money is doing in the asset class. And it'd be fair to say each obviously qualifies as a big player. Anyway, enough from me. I'll let my distinguished panelists introduce themselves. We'll go one by one. And Dennis, if we can start with you, that'd be great.
Is this working? Okay, great. Thanks. Hi, I'm
Dennis. I think you're going to have to share microphones. I think you've got 2 between 4.
Okay. My name's Dennis Lopez. I'm the CIO of AXA Real Assets. We're about a 70 billion euro organization. We operate geographically in Asia, Japan, and Australia, Europe, and North America. In terms of asset classes, we run a 360-degree investment strategy. So we do direct real estate. We do direct lending. We're actually up to about 13 billion now in our direct lending. And then we also buy bonds and REIT bonds and REIT equities globally. Those 2 portfolios around 5 billion. One of our very strong areas is development. We're running about 13 billion right now.
Thanks,
Thank you. My name is Tim Horrocks of TH Real Estate. I'm head of Continental Europe. TH Real Estate is an investment management company, believe it or not, specializing in real estate. We're a global platform with 90 billion under management in dollar terms, and we're wholly owned by TIA of America, that's Teachers Insurance Annuity Association, which is a financial services company with about $900 billion under management.
Afternoon, everyone. My name is Jonathan Harris, and I head up Macquarie Capital Real Estate in Europe. Part of a team of 70 executives around the world who have raised, as Jonathan said, nearly 60 billion US of equity, typically for client firms, dating back to 2003 for a wide variety of strategies from core through to value-added and development. The other thing we do, apart from raise money for our clients, we invest ourselves, typically in platforms. So we help people establish new operating businesses in real estate, or we invest in established businesses and try and take them to the next level, usually sector-specific, usually but not always country-specific.
Jeremy Plummer. I'm head of CBRE Global Investors EMEA business, and also head of what we call our Global Investment Partners business, which is a business investing in funds, secondaries, and co-investments. Overall, CBRE Global Investors manages around 88 billion US on a global basis, predominantly in US and Europe, but also in the Asia-Pac region as well.
Thanks, Jeremy. Okay, so we've introduced ourselves, but let's start to maybe wrap a little extra context around our discussion so you guys can appropriately position what you're hearing from us. One of the most bandied about terms in the sector, and regularly figures in our rhetoric, is cost of capital. And arguably it's the most telling bit of information about any investor when you consider their appetite for or motivation. And in the case of the gentleman on stage, I suppose we're in fact referring to the pledges that you guys have made to your underlying investors about what returns that they are expected that they're expected to generate. And I'd like, if you could, walk us through what your cost of capital look like currently, so our audience can understand what you need to achieve for your investors. And if there are any other important characteristics to the capital you think that should be mentioned, do so. Tim, I'll start with you if you would.
Okay, at TH Real Estate, on a global basis, we've probably got around 80 different mandates. That's about 436 individual clients. And of those, I'd categorize around 70 to 80% being pension funds or insurance companies. So what do those companies want from us? They're basically coming to us for core and core plus strategies. We do a little bit of value add, but I'd still argue that that's more core plus because we're in very core locations. So across all those mandates, we have various return criteria. Some are relative, some are absolute. If we're sort of looking at the absolute as a general sort of range, I suppose our investors are looking around for returns of 6 to 8%. That's a geared return. We also have a select number of investors who just want income. We've developed a number of income strategies, and they can vary from 5 up to 8, 9%. And that's predominantly with European investors. Is that capital patient? I think the capital is quite patient. They obviously want to get drawn down as quickly as possible, but we've got a number of investors who are prepared to look through cycles, so they will wait for the right opportunity. And in that sort of sector of client base, they're perhaps prepared to forego a bit of return just to wait for that right opportunity.
And Dennis, Jeremy, I mean, you guys have similar styles of investors, don't you, with similar pressure points as well. So presumably the things that Tim is mentioning, you're no stranger to either. It's that type of demand. Is that right?
Very much so. So we're seeing the strongest capital flows also coming from the pension and insurance sectors. And in terms of the required return that they're requiring, we're seeing that progressively coming down. And as they look at their alternatives, in terms of negative interest rates on bonds in some countries, it's really putting them under a great deal of pressure to invest for yield, any kind of yield.
Yeah.
And so, in a sense, we're almost the break today. I think in sort of discouraging what we think might be feeding frenzy in the market at too low yields, where the investor in principle is happy with a 5% total return against a 0% bond yield. But there are clearly dangers in that.
I was going to ask you, actually, a lot of people talk about yields in terms of the spread against fixed income, and particularly government bonds. But do you suspect that actually people spend a lot more time thinking about yields versus historical yields, and are not actually looking at the spread? Because as we heard in the panel previous, given the spread right now, it does seem to make a lot of sense. The margin seems to be acceptable, even though we're in record low yield territory.
Yeah, the new normal. Is it the new normal? Frankly, I think it's pretty clear that Europe's looking at a long runway of low interest rates, and in all of our underwriting of transactions over recent years, we've always been assuming that this interest rate cycle is going to end, and we're providing for some expansion of yields at the back end. And I guess we're constantly having to reevaluate and looking at interest rates staying low for longer. I think the counter to that is starting to appear in the US. And might invite Dennis to comment on that, saying as a resident of New York. But there are signs of us being at the end, at the beginning of the interest rate tightening cycle in the US, and that is really going to change things.
Yeah, look, it's a really unusual time. If you take the total GDP of the world, 25% of the GDP of the world is in countries that have negative interest rates, and another 30% of the GDP of the world is in countries that have interest rates below 1%. So to have 55% of the world's GDP in countries below 1%, that's never happened before. The first time you saw negative interest rates was in '95 in Japan. The first time you saw quantitative easing was in 2001. These are all relatively new things. So we're in it's a different world, and it's putting a lot of pressure on real estate yields, which seem to be one of the last asset categories to have the pressure that you've seen in fixed income and in stocks. So it's a challenging time. So I think Jeremy's right. Actually, now we're acting more as a brake. We're being much more cautious on how much capital we raise, and much more careful in where we put it in all different instances. So it's a challenging time. But you're right. The spreads between cap rates and the 10 years, which is usually where it's measured at historical highs.
Yeah. It's interesting, Jonathan, to hear some of the world's largest investment managers decline capital. Maybe not quite saying that, but we are certainly in unusual times. I think I'd add a slightly different perspective, which is that it strikes us that in this market, if you look at the big pension, big sovereign community, certainly there's almost a battle between the real estate teams. Very experienced people have been deploying capital through many cycles often, and their tactical asset allocation or group CIO type colleagues who are saying, I don't want to hear it because everything's expensive and everything's volatile. And so actually real assets, real estate, infrastructure, I'm sorry, put the money to work. Add all the qualifications you like, but you have to take your share.
It's a fascinating dynamic then that's sort of materializing here, because I suppose you've got money that isn't used to a real estate market, and of course the asset management that comes with it. But is looking for real estate to play surrogate for other asset classes that are not performing. as you say, you're sort of a break there, but the temptation to raise when it's when the demand is so high is surely there. And this is, one of the things I've been asked to do for this panel is talk about the challenges of the big players. Surely this is up there with the biggest challenges in terms of being responsible about how much you let through your doors and into your vehicles.
My comment to that from our perspective would be that on our platform, we're only prepared to take mandates onto that where we feel that we've got the specialism and the expertise locally to deliver on those strategies. I think that's a big difference to the last cycle where, basically someone came along with an idea, they'd go out and raise capital for it, and they would try and deliver on that strategy regardless. And I think the whole industry has actually moved on from that point in time.
Okay. But obviously, and as I think the audience heard in the prior panel as well, it's quite difficult for you guys to deploy your capital wisely right now. Obviously, you have your strategies, but there's a lot of traps out there as well, and the margin for error is fairly tight. In that backdrop, with that context in mind, can you just talk us through a little bit about the market conditions you're seeing right now? I know we would have heard a little bit about this on the prior session, but you guys are at the coalface putting the money to work. I'd like to hear a little bit about your experiences in terms of just how competitive and difficult it is to find assets that fit the strategies you've raised this money for. Who wants to go first on that one?
I'll go first, buy some time for you guys. I think in our business, the response to those market conditions is a little bit different. So we will essentially facilitate, help, advise, or co-invest alongside groups who are trying to respond to the pressure seeking income-producing real estate by adopting different strategies. So they might put together a developed core program, i.e. develop some high-quality assets with a bit more spread to the stabilized yield, and then hold them for 7 to 10 years. Seek a bit more return on that basis and end up with a very good quality portfolio of assets which you can't buy in the open market. Alternatively, some folks will try to buy businesses that come with a lot of real estate, but maybe come with a lot of people as well. So when you add those complicating factors, they're operating businesses, obviously the buy-side competition tends to be significantly reduced, so maybe there's a bit more value there. And then sheer size, larger portfolio transactions. I mean, it's interesting to see, IPO market here seems to bifurcate between an IPO and an opportunistic source of capital. Surely in between there somewhere, there's a capital source that can price between those two benchmarks.
Yes. I mean, and other people's anecdotes, I'd like to hear a little bit about your experiences. Jeremy? You've got very interesting pools of capital, particularly the GIP, for instance, which is able to do some of the nimble things that Jonathan had been mentioning.
Yeah, so likewise, given the sort of range of different types of execution solutions that we've got, similar sort of comment, I suppose, but across that range, we've got the opportunity for different types of entry point. I mean, the mainstream, buying wholly owned core assets for our core funds and separate accounts in Europe. Bluntly, the transaction volumes this year are running for us at lower levels than they were last year.
Business, is it?
The market is very competitive. Applying the sort of disciplines that Dennis was talking about around the bid. We're missing stuff. In terms of not being competitive on the bid, and that's fine. But so those volumes are down. Frankly, it's very competitive. Through the investment partners business, actually, we're having a much higher level of success in terms of deployment volumes, and that is because we have got things like developed core strategies, which I think is actually a good method of market access today, where we're working with development partners. And also, just being willing to structure transactions in creative ways in order to actually capture assets. So, i.e., refinancing an existing pool of assets without it actually going to market, and keeping the operating partner in place, which is what they're seeking to achieve, as opposed to actually an open market transaction where they lose control of a portfolio that they want to keep control of. So these sort of different types of market access, I think, have been very effective in this market condition.
You know, this that level of dexterity or sort of flexibility in approach is not something that every big player can afford, for instance. I mean, just to speak to what AXA and what TH Real Estate do, for instance, are you able to, you know, to take such a multi-pronged approach with a big pool of capital, for instance?
Yeah, absolutely. Stabilized core properties are very expensive, and frankly, we seldom buy them. We're looking for properties where there's something to do, leasing, refurbishment, short leases. As I said, development is something that we feel very strongly about. The obsolescence in Europe is significant. If you take a look across the continent in particular, 65% of all the office buildings are over 20 years old. And certainly the technology's changed dramatically. So we're finding that we can, in some instances, if we get in the land prices right, build new property and get very attractive returns at today's market rents. So development's very important for us. We're looking at some of the alternative asset classes, so student housing, assisted living, hotels, data centers, things in that area, wireless towers. So if you're just kind of going straight down the middle on very stabilized properties, it's too expensive right now. But if you look around the edges, there's things to do.
So I guess the message there then is ski a little bit off-piste and get involved in a bit of DIY. Okay. Now, at a similar panel at last year's Expo, I mean, I asked the panelists, somewhat crudely, I suppose, to give me their proverbial time on the clock face, just to describe, what stage we're at in the market cycle. I think you've probably got an indication of the times that this panel is going to give you. But, back then, it was only a year ago, we had a range between 6 p.m. and 11 p.m., which is quite a broad spectrum, quite a wide spectrum. And I thought that was pretty interesting, particularly as then, like here, there was a fair bit of overlap in terms of their cost of capital. So I do want to ask the same question to you guys. Now we're a year on. Am I going to get a spread of views between 6 and 11? Let's go through, you guys. Dennis, why don't I start with you? Give me your time on the clock face.
Well, the difference this time around is quantitative easing, and it's really pushed interest rates down to levels we haven't seen in a long time. The central banks have something like $13.5 trillion US dollars on their balance sheet. That's about 4 times what they had pre-financial crisis. So, normally this should be the 10 o'clock at night, 11 o'clock at night, something like that. But, in baseball terminology, we may go extra innings.
Right. Okay.
Yeah, my own personal view, it feels like 10 o'clock in the evening, but this cycle is not a normal cycle. It's not uniform across all the developed markets, and you see certain characteristics of early cycle in certain markets and late cycle in other markets.
I mean, I know it's a crude analogy, obviously, and it's sweeping generalization we're talking about here. But actually, Jonathan, I remember when we were talking offline, you gave me quite an interesting way of looking at this clock. Do you want to repeat?
What did I say, Jonathan?
Well, now, if I'm wrong, correct me, but I think you said, I think we're near 9, 10 o'clock, except time is moving slower now. So
yeah, I just read a great book on physics, 7 Lessons on Physics. I recommend it. And I think I picked up something from the 7th chapter about, I don't know, relativity or something. But no, it feels much like, if I think of it in terms of the seasons, can I answer that way instead of the clock?
Okay.
It feels like late summer going into fall.
Well, that's
I can put it that way.
Yeah. Okay. So we're not in winter.
So we're still, the clocks are not changed yet.
Okay.
Still a bit of light in the evening, so you're going to have fun. But it's pretty obvious which direction it's heading in.
Jeremy, can you give your answer with as much colour as that?
Well, I think if you look at it in pure cyclical pricing terms, it does feel like 10 or 11 o'clock. It's hard to deny that, but it also does look as though this whole recovery cycle from having been very deep in terms of the depth of the fall, that it is a slow recovery process because of the burden of debt that hasn't gone away, and so the pace of the recovery is much slower, and therefore it's going slower and longer.
Protracted, yeah.
I mean, the interesting question is what might bring this to an end, right? So, interest rates staying long, it looks like indefinitely in Europe, but what might bring this cycle to an end? What brings any of these cycles to an end? And if you look at what's brought most other cycles to an end, it has actually been a tightening ultimately of the US jobs market, leading to some inflationary pressure in the US, leading to interest rate increases which originate from the US, and it ripples out from there. And it's an end to the business cycle actually that's brought about by a tightening of the real economy.
No, interestingly, we had a New York conference towards the end of last year, and I asked the same question. Those guys were scratching their heads. So, but actually, stateside, they didn't give that kind of answer. But very interesting. You can see things more clearly. But
if you look at so that's generally been the trigger. And CBRE's done an interesting piece of research recently, looking at the extent to which geopolitical events cause the end of cycles. And actually, there's no evidence that they do. So we get very exercised about Brexit or other geopolitical events. That's not actually what ends cycles. It's just the US business cycle that ends cycles.
Right. Well, I'm glad actually you mentioned that, because it does give us a good segue to move on to Brexit. We can't have a panel without touching on it, so we will. We won't spend too much time on it, of course. In terms of where the most attractive investment destinations in the region are now, obviously we just published a German roundtable, which we put in our magazine, coverage of that event, and the prevailing sentiment was effectively that following a result of the UK's referendum, basically the safe haven status would move from London to Germany's big 5 cities. That may be a little simplistic, but some of the stats are supporting this. RCA numbers, for instance, suggest that there was 35% more investment in the German cities than there was in the UK in the first 6 months of the year. And I'd like to get a little reaction from the panel about Brexit, impact on UK, and also this theory that Germany is going to suddenly inherit the safe haven status that London has enjoyed for so long. Who wants to give me their view on that? Yeah, Tim, I think I might pick on you.
Okay. Well, I actually have my office in Frankfurt, and my view of the German office markets at the moment is they've been pretty hot all year. Post the summer break, I think pricing has actually accelerated. Is that down to Brexit? I'm not so sure. The big difference in the German market over the past few years is that the capital is not only domestic but also foreign capital. In the past cycle, if you go back to 2006, foreign capital only came to Germany because it was relatively better value. Before that, Germany was perceived as being quite a boring place to invest in. But it has its benefits in the fact it's seen as a stable market, economy is strong, and investment is currently very, very strong from both domestic and foreign capital. Do I think it's going to usurp London? Well, London is a global city. I think it's going to be difficult to displace London from being a global financial capital. I don't think Brexit is going to cause some caution. Admittedly, there may be some economic consequences in the short term, but I think over the next 20 years, you're not going to displace London as a financial and investment centre.
I mean, I want to touch on some of the tangible things we've seen, and to be fair, we probably haven't seen that much in terms of impacts on real estate markets. We thought perhaps that the run of redemptions on the 20 billion locked up in UK open-ended funds might precipitate some sort of slew of haircuts, I suppose. But in reality, I'm right in thinking there was one or two extreme reductions right at the beginning, but no more than, say, 10-15%. And after that, it was single digits. And are we to even talk about that as any kind of indicator of times to come for the UK market? Dennis, what do you reckon?
Well, look, we're very positive on London, in the medium term. I think it's just really the short term, the next couple of years. We think there'll be some bumps, but the London market, the office market's in great shape, right? Vacancies like 3% on new buildings, vacancies less than 1%. So You know, you're looking at a really tight market right now. You know, there's not a lot of supply coming on board, so and probably Brexit will knock some of that out. So I think it's really just if you're looking at things for a very short-term investment, then maybe you'd have some issues. If you have, you know, to maybe mark to market on a regular basis, you might have some issues on valuations. But in terms of, you know, if you're taking even a 4 or 5 year view, you know, we're very positive on London.
But I mean, non-sterling investors, for instance, have already given themselves a 10% advantage, haven't they, when they get in? So that's a pretty decent cushion for accepting some of the possible risks that come with this.
I think you've just highlighted one of the features of the market is that it's a global meeting place for capital, not just by country of origin, but by type of capital. So for every institutional investor that might be sitting on the sidelines because, you know, they won't take a view on currency, they always hedge regardless of where currency is. There's a Hong Kong or a Chinese investor that's more than willing to take a view on currency and is motivated by it to provide liquidity. My view is I don't think we will see significant movements in value, but we'll see a lower volume environment.
Yeah. I guess this sort of takes us back a little bit to the nature of the capital you're dealing with here. You know, and I'd like to hear from you guys, when you have your conversations with your investors, are they spending an inordinate amount of time talking about currency and about fixed income alternatives and less about the actual real estate? Are you finding that you have to maybe guide the conversation back to the actual asset class they came to see you about? You're nodding, Jeremy. Is that what you find yourself experiencing, that type of chat?
You know, I think it's you know, we've got a number of clients for which we construct global portfolios, and the amount of volatility that's been out there in the currency markets has, you know, far outweighed what's been going on in the real estate markets, so it's providing a lot of noise. So, you know, a key thing for us in the way that we set up any mandate with clients is to anticipate that, make it clear who's responsible for the currency risk, and, you know, frankly, we would prefer that they are, and they choose whether or not they should apply a currency hedging overlay, which we would prefer them to do, actually.
Right, okay.
And then incentivize us to be you know, focused on delivering the real estate return.
So you guys won't hedge yourselves?
Currency betters ourselves, because, you know, frankly, that's not our expertise. But, you know, there are some clients who obviously choose not to do that, and then, you know, we're seeing a lot of noise in the returns from currency effects right now.
That's interesting.
Just because of the volatility that Jeremy mentioned, we've kind of looked into it. If you, let's say, take the dollar pound over the last 20 years, if you could hold an investment unhedged, you're pretty much the same as a pound investor, frankly. The difference is very minor. But if you look at the volatility during that time period, it adds something like 60-70%. So it's really having to manage the short term. If you have a long enough time period, you're okay. So, but, you know, very few people have 15 to 20 year horizons. That's a problem.
Jonathan.
Obviously, they can be hard to measure, but currency has second order effects. I mean, you know, tourism is booming in the UK. Retail spending associated with that is strong. So, you know, hospitality markets are benefiting accordingly. You know, manufacturing just had the strongest PMI in quite some time, you know, against expectations for manufacturing in the UK. So now whether that will be sustained over the next 2 to 3 years when we untangle this mess we're in, you know, who knows? But short term, at least, it's having some benefits. Industrial properties benefiting at an occupational level.
Jeremy, I think you remarked to me offline that it's the industrial companies that have barely taken any hit at all. You know, when you saw when Brexit occurred ultimately, or in terms of the decision, you know, you saw a pretty calamitous drop in share prices. Obviously, we saw what happened in the open-ended funds, but the ones that didn't seem to do much were the logistics guys. They're sort of weatherproofed a little bit, aren't they?
Well, that's true. I mean, I think if you look at the equity share prices of the UK propcos, there's a marked difference depending in you know, which area of the market they're operating. So the largest industrial REIT in the UK, Segro, share price today is around 10% higher than it was on the 22nd of June.
Amazing.
And actually, you know, that's driven by real things going on in terms of fundamentals in the logistics market in the UK. So there were actually record levels of take-up in the logistics market in July and August for those months, which are normally quite quiet months. Yeah. But immediately post-Brexit, there was actually big momentum in the leasing market. And that's reflected into the equity share price, which is interpreting that as, okay, so Brexit has no negative consequence for the structural dynamics of the logistics market. But then, by contrast, the stocks that are more focused specifically on London, definitely trading below their pre-Brexit levels, yeah. And that's clearly where the concerns are more focused.
Yes.
And frankly, where I think the greater risks lie. Yeah. Depending on how crazy the UK government chooses to be.
Yes. I think with that comment, we'll leave the UK shores and actually start talking about some of the other European markets of interest. We touched on Germany, as I said. We touched on UK. Which other European markets are making sense to the big players right now?
Well, we're active in all the European markets, but with the strategies that we're pursuing, we're having to be selective in how we. And we touched on this before, how we actually access the stock.
Yes.
But, generally across the board, we are continuing to look at, from the Nordics down to Southern Europe.
Right.
So we're active in all countries.
I guess it's a similar answer for all of you, right? There's opportunities.
I don't think for us there's any geographic themes anymore. We had a few, and I think now it's just looking for needles and haystacks, and they can be anywhere. Needles,
looking for the needles. Speaking of looking for the needles, actually one of the markets that we found quite interesting recently has been Italy. One of the reasons, I suppose, is because, we've done a bit of coverage on some of the core deals, some of the offices and retail parts, but we covered opportunistic firms also setting up shop in anticipation and, dare I say, hope of being able to work with the banking sector as they work through their non- and sub-performing loan portfolios. Supposedly, this is an €80 billion opportunity. Latterly, we also covered some of these guys parking themselves outside the 20-odd retail funds in Italy, which are trading at attractive valuations, supposedly. So I'm interested, to hear from you guys. How do you do the Italian job right now? What's the best way of approaching these opportunities? Or do you not?
I'll buy some time for my colleagues again on the panel, but and it's not born out of enormous transactional experience in Italy, but on the NPL front, very difficult place to actually access the real estate, ultimately. So that opportunity, fairly obvious opportunity, comes with some pretty significant caveats, I think.
Yep.
It's always struck us as one of the markets where it's a little harder to strike enduring partnerships with local asset managers, particularly in specialized sectors.
Why is that?
Business cultural factors, I guess. Probably not having made the long-term investment in the market to really know it well enough. People tend to flit in and out. People are permanent features in France, Germany, UK, Netherlands, Italy's. That's often not the case.
Is it wise to flit in and out of Italy, or is it a better idea to actually set up camp and get to work there?
I think I'd echo the comment that through our investment partners business, we have always struggled to find the right local operating partner to do things with in Italy, and we haven't actually had any great success with that. So our main activity in Italy is through just direct investment, specifically focused on retail, which we think is a functioning market in Italy, both shopping centres and more high street shops. But we find the other sectors pretty challenging.
Tim?
No, I'd agree that Italy is a challenging jurisdiction. Having said that, I'm a big Italy fan. I own real estate there myself. But we've been there as TH Real Estate for 15 years. And I would say over that time period, we have put down roots in particular sectors, particularly the outlet sector. But from my point of view and the experience of all the transactions I've been in, it's always been easier buying from fellow Anglo-Saxons than an Italian partner.
Right, understood. Okay, let's move on a little bit. one of the things that the Expo organisers also asked me to touch upon was, the mitigating of risks by the bigger players. What are the sorts of things that could upend the large players in our sector? And I'd like you, it's a pretty broad question, but I'd like you to each think of an answer to this. If I asked you where you considered the most danger to your business strategy right now, given your scale and in the market, what would you say it is? And also, how are you handling that danger? Well done.
I mean, the lesson from the last cycle, right, was all about leverage, right? And the temptation today, debt is almost free. Why wouldn't you leverage as aggressively as you could? And if there were then a price correction, it would be, in terms of the impact on the equity, it would be just like last time.
Yeah.
So, I think one's got to be careful with the temptations of leverage, and certainly whereas a lot of our investors, they're very focused on cash yield as the thing that they want. They're so yield hungry. That encouraging you to use leverage, because that's certainly an enhancement to the cash on cash return. But I just think we've got to exercise prudence around that, where what the investors are really looking for is a low volatile.
Well, what about the lenders
return.
themselves? Are they slowly creeping a little bit into being a little more aggressive with the lending, or are they actually just as conservative? And have they learned the lessons too?
I think generally not. Attitudes clearly varied, so there would be sweeping generalizations to say not, but I would say there's generally more conservatism in that area than there certainly was at the same stage of the last cycle.
Right. I mean, Dennis, you're a lender as well as a
Yeah, we're running a 13 billion portfolio, so the reality is no. I think that it's a little bit, it's different than it was maybe 4 or 5 years ago, but still, the days when you see even 65% loan-to-value deals are very few. So the markets, I think, on the risk side stayed appropriate. On the spread side, it's gotten more aggressive, but even then it's come back a bit.
Okay.
So I think the regulations that a lot of the banks have curtailed as much participation in the market as maybe at the last peak of the cycle. So it's okay, and I think actually that's a good way to look at it too. It's kind of the canary in the coal mine. When the lending deals start getting too high and too crazy, that tells you something about the market.
So you guys would agree then this is the major risk then, when you're an operation at scale, taking the wrong policy on lending across a business is pretty much the number one risk, right?
I'd highlight a different one, which is, I think, to a greater lesser degree, probably everybody here is engaged in greater specialization, partly as a response to scale. These are large pools of capital. You're closer to your operating partner. In some ways, you're more dependent on your operating partners or your own specialized sector teams. And depending on what sort of crisis we have, what sort of catalyst, we saw last time, teams, businesses get scattered to the four winds. There's a big risk when you're doing specialized niche real estate investment, whether it's geography or it's the style of investment or it's a niche asset class, in keeping that team together and keeping the skills sharp, when they're most needed, you could argue.
Got it. Tim, did you want to add one more thing?
Spontaneous answer to the question. I'd come more from the occupier side. I think with regard to strategies that we look after, I still feel that the economic cycle is weaker than it's probably portrayed, and that I wouldn't want to take excessive occupier risk at the moment.
After all, it's easy to forget that these are the guys who actually make a real estate investment viable or not viable. Without a tenant, the whole thing's moot, right? So, okay, I've been given a bit of an indicator to start winding things up, but I didn't want to do so before I finish up with a game. I'm hoping that this is going to work. It's a game of either or. I've done this behind closed doors for a feature once, and it worked pretty well. But I've never done it in front of a live audience. So do bear with us. Now, here are the rules. I'm going to give each of you. We want to play a game, don't we? People want to hear a game, right? Okay, good. So I'm going to give each of you a series of questions, each one comprising 2 options. And obviously, they're going to relate to real estate investment. And you need to respond immediately. And the name of this game, the nature of this, is to hear what your instincts are. I don't want you to have to think too long about it. And to make things fair, I will alternate the direction in which I ask these questions. So, are you ready? Dennis, I'm going to start with you. What is the greater concern to you, future interest rate movements or currency volatility?
Interest rates.
Tim.
Rates.
Interest rates.
Jeremy, what is the most important, current versus historic cap rates or current cap rates versus current fixed income yields?
Current versus fixed income.
I think you took a long time there, Jeremy. Jonathan, what's your
I'm
answer?
going to be much quicker. I agree with him.
Okay.
I agree.
Okay, there's a pattern emerging in this game. Okay, number 3, Dennis, what is the most attractive form of capital support right now? Is it fewer but larger non-discretionary commitments or many but smaller discretionary commitments? What's more attractive? Answer, please.
Smaller.
Larger.
Larger non-discretionary.
As a manager, smaller discretionary.
Okay, all right. I still think we're pausing a little bit too much. I need some more instant answers, please. Okay, number 4, is it better to maximize borrowing in this low interest rate environment to get deals done, or to focus on reducing gearing levels in anticipation of a downturn? Jeremy?
The latter.
Jonathan?
It's not an either or an or. Just price the refi risk right.
The latter.
Yeah, gearing.
Okay. Number 5, what is the most attractive, a prime property in a secondary location or a secondary property in a prime location? Dennis?
Secondary and prime.
The same.
Yeah, the same.
Same for me.
All right. Number 6, what is the most important, the strength of a building's current lease or a building's potential to release? Jeremy?
I'd go for the latter.
Okay. Potential for release.
Yeah, it's a long-term game, real estate investment.
Release.
Potential for release.
Okay, good to see we've got like-minded people on stage. Okay, number 7, what is the more defensive property type, a CBD office or a top brand shopping mall? Dennis?
Top round shopping mall.
Shopping.
The mall.
Yeah, the mall.
Okay, shopaholics, fine. And number 8, what is the more institutionally friendly asset class, or which is the better for an institutional portfolio, student accommodation or senior living? Jeremy?
Student accommodation.
I think it depends a lot on the geographic market.
Pick one.
Student in Germany.
Okay.
Student accommodation.
Student, absolutely.
All right, so we're backing the youth. Okay, number 9, private rented sector residential investment in Europe. Is this a worthwhile addition to an institutional portfolio or a fool's errand at this early point in its evolution? Dennis?
It's good addition.
Good addition.
We've done a lot of it. It's a great addition.
And a final question, which I think is going to be quite interesting. What is the more important hire at this point in the market cycle, investment professionals or asset managers? Jeremy?
Investment professionals.
Jonathan?
Asset managers.
Asset managers.
Ooh.
Investment professionals.
Oh, that's good. Good. We got a split there. Okay, we're done. Thanks for being tremendous sports. That was quite fun, wasn't it? I've hogged the mic. Do we have any questions from the floor at all? Have we given... You've got one? Good. Excellent. Gentleman in the front row.
Hi there. Given deploying capital is much harder than raising, you're saying at the moment, are you doing anything to source assets more efficiently than you weren't doing before, either using your network technology or otherwise?
I mean, I referenced earlier different sourcing channels and the flexibility to invest directly, invest through operating partners, but also invest through different kind of structures and recapitalizing existing vehicles. So I think you've got to be much more flexible about your entry point in order to figure out how to get access to assets today, rather than just bidding on the open market.
We're looking at creating platforms or tying into smaller platforms that can create the assets. So
Okay. One more question, lady in the front.
Thank you. Not really about investment strategies, but regarding the future of real estate, with WeWork's valuation of 16 billion in the last 5 years, what do you think of co-working, and where do you see real estate going?
So this is the actual
Maybe
use of the real
questions.
estate you're asking about?
Yes.
Okay. Who wants to field that?
I'll pass on the future of real estate, but co-working, really interesting space. It just feels very early in its evolution to me. And if I'm honest, I think it's tough to underwrite imagining that it's a stabilized asset class. So where we've looked at it, it was actually looking at backing a platform with a basis into the assets which looked overwhelmingly attractive to compensate us, frankly, for our inability to foresee the future, for this asset class.
Anyone else got a position on that?
Well, one of the issues with that model is that you sign long-term leases for the building, but short-term leases for the tenant. So when markets change, then that can cause problems. But if you manage that properly, that's the challenge of that business model. In terms of things changing, you guys all saw that Uber's testing driverless cars in Pittsburgh. So if we start having that become more common, one thing is, do you need to have all the parking spaces you have at shopping centers? And maybe you can do something else with that space. So there'll be some changes, I think, coming to real estate. That's just one of them. Obviously, e-commerce and logistics. But I'll leave that one to Jeremy.
Okay.
Well, look at it is that if you look across the 4 major property types, we need more housing. We actually need more warehouses, because warehouses are, to a degree, replacing shops. We need less shops. And I think we will be surprised by the extent to which we need less shops, that will go beyond some of our kind of worst forecasts. And we probably need less office space because of co-working and different ways of space sharing and more working from home and flexible working practices. So you've got 2 property types you need more of, and 2 property types you definitely need less of. That's all I can say.
All right. Okay. And on that note, I think we'll draw the session to a close. Panelists, thank you very much. That was pretty illuminating. I enjoyed it. I hope you guys did too. And if you would, give my panel a round of applause. We'll call it time.